The difference between revenues and COGS gives us gross profit. Computing the latter is the objective of this lesson. Since we have generated 1,000 potential revenue and COGS values, calculating the simulation of gross profit requires us to combine the revenue and COGS. We created COGS as a negative number, so it is correct to use a plus and not a minus sign here. I hope you agree it is normally distributed with mean value equal to the difference between the mean of the revenues and the mean of COGS. From this moment, with the help of the max and min functions, it is straightforward to obtain the biggest and the smallest potential value of gross profit. The method's mean and STD can provide an output equal to the mean and the standard deviation of the gross profit, respectively. Basically, we can say at this moment, you have done your job. But it is a good idea to plot these results on a histogram. What is a histogram? This is another graph that helps you identify the distribution of your output. The syntax to implement it is identical to the one we used for a regular plot, but the difference is that on the second line after PLT, you need to type hist. Then, you could add many arguments, but two are important. One of them is the value of interest, which, in our case, is gross profit. The other one regards the bins. What are bins? These are the chunks in which the data in the plot will be divided. There are two ways to use bins. One way is to create a list whose elements separate the bins along the x-axis. If our list contains the numbers 40, 50, 60, and so on until 120, then we will see observations between 40 and 50 grouped in one bin, between 50 and 60 grouped in another, and so on. Here, the bins are too big, and it is hard to agree our data was normally distributed. The alternative procedure is to assign the number of bins directly. If I ask for 20 bins, the computer will automatically split my data into 20 equal intervals, and this time, it will be obvious the numbers are normally distributed. This is a great example of a tool that can be useful to a finance manager working in a big company. Although there are more complex distributions or procedures out there, it is such analysis that can help him predict future revenues, costs, and margins. In the exercise that follows, we will ask you to predict a firm's EBITDA, the account that equals the difference between the gross profit and the firm's operating expenditure. Thanks for watching.